recent pain in the market has presented some amazing opportunities for us to buy stocks at discounted prices that we can hold for months, years, or even like maybe a decade. So we're going to talk about 8 of those stocks today. There are a lot more than 8 stocks that I think could be great buys right now, but I had to pare down the list to the top 8 that I see right now in this moment. This is April 2023. Before we get into that, welcome to anyone that's new and welcome back to anyone who has been here for a while. Okay, I'm Austin. I'm a co-owner of cloudmusicsuite.com. I'm also a stock market investor. We're around 125 subscribers right now. It means the world to me, every person who subscribes. Thank you so much. 125 or so strong. As a thank you for subscribing, let me show you pictures of my cats. I have 2 cats now. I recently just got a new one. Okay, so we have Millie, she's the gray one, and then Luna, she's the brown one. They're beautiful. They said thank you for subscribing. All right, let's get into this video. Some of these stocks I actually own in my Patreon portfolio. So for just $5 a month, I just lowered the price. You can check out every single buy and sell I'm making in the market right now. It's a totally separate portfolio that I've got. I'm only putting $50 a week in there to try to prove that it's totally possible to build a beast account with $50 a week, buying consistently over time, great stocks, building out a portfolio. It's not index funds, it's totally stock picking in there. I talk about my thesis for why I have each stock, etc. $5 a month. For the first 5 patrons that we have, I'm gonna do a portfolio review as well, okay? If you allow me, we'll do it publicly on the Patreon so that all the patrons can see it. Otherwise, it'll just be straight to you only, but first 5 patrons will be doing a portfolio review. Look forward to that, okay? Head on over there, it's link in the description and pinned comment area. All right, let's get into it. 8 stocks that are amazing buys right now. Number 1 is 3M Corporation. So this is ticker MMM. I'm sure you've heard of this company. They're an industrial conglomerate, own a gajillion different brands. They make PPE, right? Personal protective equipment. They have masks and gloves and earplugs and all this type of stuff. They are a huge industrial conglomerate. The reason I think it's a great buy right now, or at least something you should look into, is because they've got a couple of lawsuits going on right now, which could seem like a terrible thing, but I don't think they're going to materially affect the profitability of the company or the growth of the company moving forward. One is around like these forever chemicals and plastics, kind of an issue, and the other one is around these earplugs that they made. They bought an earplug company. The earplugs didn't work as well as they said they were going to, and then there was a lawsuit that came out of that class action lawsuit. But I think once those subside, we'll get some positivity in the stock again. This is a pure value play. Amazing company, great dividend, one of the best dividend payers of all time. It's a dividend king. It's been raising its dividend for over 50 years, every single year, year in and year out, irrespective of the situation we have in the economy, which is absolutely ridiculous, okay? Also, they're at less than half of their average PE over the last 5 years. Less than half of the average PE, which is price to earnings ratio. Totally ridiculous. It's at least worth considering putting some money into 3M. I don't think you're gonna get a double up, but I do think you're gonna get a great dividend over time. They're gonna raise that dividend over time, and I do think you're gonna get some great price appreciation as all the negative news around 3M goes away, and it gets back to its average 5-year PE ratio. Okay, so sitting at these low PE ratios is probably not sustainable for 3M. They're just gonna become more profitable. Hopefully the stock price moves up with that. Historically, stock price moves with profitability. As earnings go up, share price goes up over time. It might not be a 1-to-1 correlation all the time, but over time, those things are going to end up kind of matching the same trend line. So that's the hope there with 3M. Great company and deep, deep value play right now. Next up, number 2, Disney stock. So Disney stock is a similar situation to 3M, deep value play. They are having a huge cash burn situation, and a lot of it was due to the CEO that they instated a few years back. They have now moved off that CEO and gone back to their old CEO who led them to great, great heights, great profitability. His name is Bob Iger. So he's back. He says he's going to be back for a few years. I think he'll be back longer than a few years because he's got a great CEO pay package there with a lot of stock. Anyway, I think he's going to take Disney from cash stressful situation to cash rich situation in a very short amount of time. He already started by cutting employees, and that is I know that sounds horrible, but it's a very important thing for the profitability of Disney, okay? This stock is sitting at COVID lows. When every park was shut down, the whole world economy was shut down, Disney is trading at those level of, in terms of stock price. So ridiculous. It's also lower than its 5-year PE, which is good. It's not crazy lower because, like I said, they've had a cash burn situation, so their profitability has actually taken a big hit, and that's a lot of the reason why the stock has taken a big hit. I also think over the next few years, they're going to reinstate their dividend. They used to be an amazing dividend company. They suspended that dividend throughout COVID, so they've been able to retain more of those profits. But I do think they're going to, as they reach higher levels of profitability under Bob Iger again, I think they're going to reinstate that dividend, and that'll make the stock soar to the moon. Because this is typically seen as a dividend payer, a little bit of growth, and a value play. Okay, and it's a great management team. They have an insane amount of intellectual property and copyrights and all that. So Disney is number 2. Great stock to put some money in. It's just not sustainable for it to stay at these COVID lows for any longer, in my opinion. Next one up is very growth focused. This is Palantir. So this is ticker PLTR. You might have heard of Palantir before. They have 4 technology platforms, okay? These 4 platforms are all around data aggregation and decision making, machine learning and AI decision making. So they sell these products to governments and big corporations to help them make better decisions as an organization. Okay, very, very valuable company in terms of the use. Palantir is absolutely ahead of their time, in my opinion. I don't think the stock is getting as much love as it would if it was to go public 2, 3, 4, 5 years from now. But stock went public a few years back through a direct listing, and they just reached their first quarter of profitability. That's huge for this company because a lot of people have been saying, yeah, Palantir has great growth ahead of it, 25 to 40% growth on a year-over-year basis, which is so ridiculous. 25 to 40% is super crazy. They had a 30% target. They missed that 30% target on their last earnings, and they're going to probably miss it on the full year 2023. We shall see what the future holds. But still, 25% growth is absolutely amazing. Getting to profitability for this company is absolutely amazing too. One other thing that people get worried about is share-based compensation with Palantir. I think that's going to start to drop off a cliff over the next few quarters until it's at a reasonable level with the rest of the tech companies. So this is the first growth company that we've got on here. Palantir, I think, is going to be an absolute growth beast over the next decade, and they're going to be a profit machine over the next 5 years. That's my opinion. We'll see what happens. I think Palantir is a great company to look into. When companies start to turn that profitability corner, they normally get a lot of love from the market because a lot of investors have 0% chance of investing in an unprofitable company, which is not the most unwise thing in the world. It's a good rule of thumb. But what that means for someone who invests in a near profitable company means they're going to get probably a big pop once this company hits profitability. So Palantir is a company to look into. Of course, do your own research on all these companies, including Palantir, Disney, and 3M, and all the rest of the ones that are on this list. Next one up, Costco. So Costco might be the one I'm most excited about on this whole list, believe it or not. I don't think Costco right now is a deep value play. It's not like it's insanely undervalued. I don't think Costco is an insane growth beast like Palantir. Costco is at fair value right now. They're a great, stable company. They're very, very inflation proof because they sell needs-based products. You know what Costco is. They have a big wholesale stores where they sell a bunch of food and they sell any consumable you would need for your home and much more than that. So they've got these big warehouses, right? You've seen them probably. Anyway, they have respectable growth. It's not crazy growth. It's somewhere around 6 to 8% per year. That's respectable, okay? I've seen some projections that are upwards of 10% growth per year for the next 5 years. I've seen some as low as 4%. But let's just average that out to, somewhere around 6 to 8%. That's respectable growth. They're also a cash generating machine. They pay a great dividend. They also do a lot of buybacks to help reward shareholders in another way other than just dividends. And they pay special dividends on a relatively regular basis that are like super hugely massive. I think the last one was around $10 a share for the special dividend. So that's crazy. Also, this company has we'll just say Berkshire floor underneath it. Charlie Munger is an absolute Costco bull. He's probably the biggest Costco bull I've ever heard of in my life. Charlie Munger is like Warren Buffett's right-hand man. So I seriously doubt Charlie Munger is selling any of his Costco shares anytime soon over the next decade. I don't think he'll be around for another decade, as sad as that sounds, but it's in his family portfolio as well, the Munger family portfolio. So I would say that they're going to hold those Costco shares forever and ever and ever. And if there's any meaningful dip in Costco due to some bad news or a bad quarter, you know what's probably going to happen? They're probably going to buy more Costco shares, and they're going to put more buying pressure on this, moving the stock up. So there's kind of a floor underneath Costco. That's one of the reasons I think it's always at fair value. Unfortunately, it has never really hit undervalued territory. Of all the time I've been in the market, all the time I've been looking at Costco stock, I literally have never bought Costco stock until this week. So that's one of the stocks I just opened in my Patreon portfolio. If you want to check that out, link in the description. Okay, you see all the moves I make in there. All right, Costco, great company. Let's move on. Another stock that has the Berkshire floor underneath it that I think is a great opportunity right now is RH. So RH is Restoration Hardware. It is not a hardware store. It's actually a really extremely high-end furniture store. They have these big superstores. They're so elaborate. They're beautiful. They're amazing. The furniture is extremely, extremely expensive. If you've been in one of these stores, you know what I'm talking about. Just like a little lamp is like $700. It's ridiculous. They also have these rooftop bars that are amazing. Like, I know it sounds silly to have a restaurant in a furniture store, but dude, it's so good. Very, very, very good food. Awesome experience. The scenery and the setting is just beautiful. Service is amazing. Anyway, I don't need to go on and on about RH, but they're a really, 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 really awesome company. Great for the long term, in my opinion. Their PE is less than half of their median PE over the last 5 years. So their median PE is in the high 20s. Their current PE is around 10 or 11, okay, depending on when you're watching this video. You can go check it out for yourself. That is crazy. I know there's going to be some short-term pain for RH. I don't know how low the stock is going to get. I would be extremely interested if the stock dropped below $200, but I'm already interested right now in opening an RH position. I got to do more research before I choose to open this RH position, but it's definitely a stock I'm looking to buy in this moment right now. It's definitely a value play. It might become more of a value play. So just be ready for some pain if you choose to open an RH position. I don't know how low it could go, but I do think it could drop a decent amount more from here. Great growth in this company. I would consider it a growth company, absolutely. So if you're looking for a long-term position, RH might be that one. Just be ready for the upswings and downswings, because it's very heavily linked to the housing market, and specifically the luxury housing market. So last thing about RH real quick is that Berkshire owns Berkshire Hathaway. This is Warren Buffett's company. If you've never heard of it, they own, I think, about 10% of all of RH stock. That's super crazy. That's a big floor underneath RH that is probably going to be there for a very long time. When Warren Buffett buys a stock, it's not like he's trying to get in and out of this stock in a short period of time. So this is good news for RH, because just like with Costco, if RH drops in any meaningful way, Buffett and Berkshire are probably going to increase their position substantially. That's how they do things. Anytime they see a value opportunity, especially in a stock they already own, they are definitely going to buy more shares of that company. They're not going to do what the typical market psychology would be and sell into the weakness. They're going to buy into the weakness. So something to consider, okay? Next one up here is ADP, okay? ADP, Automatic Data Processing. The ticker is ADP on the market. This is a great dividend growth company, absolute dividend beast. And I would say this is another fair value type of company. Just like just like Costco stock that we saw a second ago, I would say ADP, it's not a deep value play. I would say this is very fair value, getting a great company at fair value. So ADP is like a human capital management company. They do benefits and HR and payroll and talent management, workforce management, retirement services, insurance, et cetera, et cetera, et cetera. So they do all the things that help you run a company to keep your employees happy. Really, really important company, super sticky business model. Once you move all your HR stuff and your benefits stuff to ADP, you're probably going to stick with them as a company for years and years and years, because it would be really tough to switch to someone else like Paychex or any of these other competitors that are in this space as well. So very sticky business model. Once they land a deal, they've got it for a long time probably. Okay, great growth on this company. It's a little bit below its 5-year PE. 5-year PE is around 32, current PE is around 29. That's a little bit of a value play. I wouldn't say it's crazy, but for something like ADP that's so stable and so great at growing over time and very, very inflation proof as it relates to their revenues and their earnings, and the fact that they're a dividend beast, and the fact that their balance sheet's always in an amazing spot, and the fact that they've got respectable growth, I think this is definitely a company to look into. This would definitely be a long-term hold. Don't expect to get a 40% gain this year on ADP shares. Maybe expect to get a 40% gain over the next 3 to 4 years. That would be a great position for you. ADP is definitely something to look into if you're looking for a fair value, great stable company that's kind of boring, okay? Check out ADP. Next one up, SoFi, okay? SoFi is definitely a growth company, probably the riskiest company that's on this list. You know, it would be between SoFi and PLTR for riskiest company on this list. But I just want to take a sec and compare SoFi to JP Morgan Chase. So we're going to look at the price to book ratio of SoFi versus the price to book ratio of JP Morgan Chase. And then we're going to look at the revenue growth of SoFi versus the revenue growth of JP Morgan Chase. So everyone knows JP Morgan, biggest company in the world in terms of banking, or I should say most important company in the world in terms of banking, in my opinion. Okay, so SoFi right now is trading at a 1.0 price to book ratio. Definitely the most important metric to look at as it relates to bank stocks. JP Morgan right now is trading at a 1.4 price to book ratio. Significantly higher than that SoFi 1.0, 40% higher. Okay, that's something to think about. Now let's compare the growth. You would think, okay, SoFi's got to have way less growth than JP Morgan to be trading around a 1.0 price to book versus a 1.4 price to book. You're very wrong, okay? SoFi is looking at around 25 to 35% growth this year and next year. JP Morgan Chase looking at about 6% growth from the best estimate this year and about 1% growth from the best estimate next year. Okay, that is a massive difference. You would think SoFi would be trading about 6x higher than JP Morgan on a price to book ratio. So you think it'd be sitting at like an 8 price to book. It's sitting at a 1 price to book when you compare those growth rates. One thing that JP Morgan has going for it, well, two things. One, extremely proven management team. They have proven themselves time and time again to last through the tough times. SoFi has not done that. So that's an important thing to consider. Second thing to consider, SoFi is not profitable. They're still taking losses, and they might take losses all of 2023 and some quarters in 2024. That's kind of scary for an investor because that means they might have to raise cash through share dilution or something along those lines, or taking on more debt, which would put them in a worse balance sheet situation. So JP Morgan definitely has SoFi by a mile and a half on those two things. Proven management team, JP Morgan's way more proven than SoFi, and profitability, okay? JP Morgan is a profit beast. SoFi has not turned a profit yet. So that's something to consider, all right? You just gotta weigh your risks. You have to define very well what your risk appetite is if you're gonna buy SoFi shares. Be ready with any of these growth stocks for big ups and big downs, okay? Next and last one here, Vital Farms. Vital Farms, you might not have ever heard of this company. If you shop at Whole Foods or something like that, you've probably seen them, but this is like a high-end, I guess is the best way to say it, egg and butter company. That's the main two products they sell is eggs and butter. If you're looking for really hippie eggs, the biggest company that sells those really hippie eggs that are like really, really high quality, amazing eggs is Vital Farms. Their eggs are super expensive, but their eggs are super, super, super good. They also sell butter and other, things in the dairy category. They're gonna expand to like egg bites and more of the ready to eat type things. They've already started doing that. Their ready to eat products are really, really good. But this company is expanding, getting more market penetration, getting into more stores over time. They also have a great deal with Whole Foods. Whole Foods owns a hefty portion of Vital Farms. It used to be underneath the Whole Foods, or I should say, it used to be underneath the Amazon branch, and then they split out to make Vital Farms. Really, really great company. They're already profitable. I love Vital Farms, and I see a big shift happening right now towards animal-based eating. If you haven't heard of what this is, it's basically like you center your diet around animal-based foods, and at the center of that oftentimes is things like butter and eggs. Butter and eggs are at the center of a lot of animal-based diets. People like Joe Rogan, people like Jordan Peterson, people like Peter Attia and Paul Saladino. These guys are all over social media talking about an animal-based diet. Vital Farms is going to be a big recipient of a lot of that revenue because along with the animal-based eating, these people who are proponents of it talk heavily about the quality of the food is extremely, extremely, extremely important that you're putting in your body. If you're eating these crappy Eggland's Best white eggs all the time and you're eating like 50 of them a day, you're probably gonna feel like shit because they're not high quality eggs or crappy butter or whatever the case may be. You know, the higher the quality of the animal product, the more likely these people are to recommend it to you. So something like Vital Farms is probably gonna get a lot of press over the coming years, assuming this animal-based trend kind of continues for a little bit. We'll see. I don't know. I do like Vital Farms from an investment standpoint, though. I wouldn't put all the eggs. I wouldn't put all the eggs in one basket as it relates to Vital Farms, but I do think it's nice to have a food play in there. Very much inflation-proof. Great company. Okay, that was it for today. 8 stocks that I think are great buys right now. This is probably a really long video. If you made it this far, thanks so much. Check out the Patreon, link in the description. First 5 people to become patrons are going to get a portfolio review, either public or private, depending on what that person desires. Hit that subscribe button if you're still here. Thank you so much, and have a great day.